strategies, but when you do use those types of strategies, you just want to make sure you have everything, all your T's crossed and your I's dotted, so that if an audit ever does come, you're ready to go.
Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larson. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in. On today's show, we welcome back my friend Thomas Castelli. Thomas is a tax strategist and a real estate investor who helps other real estate investors keep more of their hard-earned dollars in their pockets and out of the government's. Today, we're going to talk about some updates to the 2023 tax code, as well as strategies that you can use to keep more of your own money. Thomas, welcome back to the show.
Hey, Chris, thanks for having me. Always a pleasure.
Yeah, no, it is a pleasure, and it's more of a pleasure to see you than to write checks to the IRS, like a lot of people are getting ready to do here this next week. And always love having you on to talk about updates that we're seeing, but more importantly, how we can proactively address our tax situation.
Right.
I think a lot of people say, "Oh yeah, I got a CPA," or I have an accountant that does my taxes. And I often talk about, Thomas, how people, especially investors at a high level, really need a tax strategist. So if you wouldn't mind starting out, telling us a little bit more about the background of the real estate CPA and what you do and how you're different than just a typical quote unquote accountant.
Right. So the real estate CPA, we're an accounting firm where we only work with real estate. So all of our clients are investing in real estate in some way, shape, or form. Some of them are investing in single family rentals. Some of them are doing multifamily. Some of them are syndicating deals. Some of them are funds. Some of them do short-term rentals. All types of different things. So that's the one string that holds the real estate CPA together, is that commonality. And I think also what we do differently is we focus on advisory first, or like tax planning first, for example, because we realize that that's what actually moves the needle. All right. It's when you have your tax return, all it is a report card of what happened in the prior year. So really, when you go through tax strategy and tax planning, you're starting to look at, okay, well, what strategies can you use? What tactics can you implement this year so that when it does time to file your tax return come tax season, you're actually impacting the needle. So that has been tremendous for our firm in terms of the ability to work with clients in a different way. But we've also been able to save investors thousands and thousands of dollars in taxes every year for many years now. So it's been very exciting. And I think that that's kind of what separates us. Now, what most CPAs do, or most accounting firms do, is they just file the tax return. So you go see once a year, they'll file your tax return and they'll say you owe this to the IRS or you're going to get a refund. Congratulations. And that's about it. They never really tell you to do in terms of how to minimize taxes. And so that is key. If you want to minimize taxes, you have to be proactive. You have to get with an advisor who's going to be able to help walk you through it, or and then go ahead and implement those strategies and be able to impact your tax situation.
Yeah, and look, I can say from a testimonial perspective, first off, I'm one of your clients, and you have helped me and my coaching clients save literally hundreds of thousands of dollars here, just since we started working together in the past couple of years. It's probably, I wouldn't be surprised if it's over seven figures at this point, just with that small group. And listen, one of the reasons people might say, well, why are you having Thomas on now? It's April, like we're already in tax season. The reason is you've probably, if you filed your taxes on time, you probably know what your tax bill is, and you're probably thinking, okay, what can I do going forward? And in my opinion, it's April 2023. It's the best time to look forward and say, okay, what are some different things that we can do? Before we get into that, Thomas, we've had some changes here, specifically when it comes to real estate. And, one of the big things was the 2017 changes that occurred under President Trump. Some of those have changes, such as depreciation. Do you mind sharing a little bit about, the updates, the changes, what that means to investors, and anything else that is really materially changing in 2023?
Right. Yeah, that's a great question. So start here. So way back in 2017, they implemented the Tax Cuts and Jobs Act, and with that came 100% bonus depreciation. basically properties that were placed in service from September 27th, 2017, random date. I have no idea. Through December 31st.
It was a random date, probably to satisfy some senator's, purchase or something like that. It was like September 29th or something. It was crazy.
Yeah. It was just so random. I'm like, I don't know why they picked the date they did. So it's like, okay, from like the tail end, maybe like the tail end of 2020, 2019, excuse me, 2017, all the way through
a while ago.
December 2022. If you place a property in the service, you were able to get 100% bonus depreciation. And what that meant is that the 5, 7, and 15-year class life could be 100% depreciated or expensed, in other words, in that year that you acquire the property. And that's been significant for taxpayers. Just to give a quick example of what that may look like. Let's just say you had a $500,000 property, just going to go right down the middle.
Okay.
Let's say that 25% of that property can be reallocated to that 5, 7, and 15-year property. I mean, we're looking at
Thomas, real quick. I apologize to interrupt you here. So just to kind of pause for a second. So commercial real estate is typically depreciated on a straight line basis. That's the equal amount every year over 39 years, correct?
Right.
And then residential is over 27.5 years. But what you're referring to is is property inside the property, which, like, what's a couple examples of 5, 7?
Yeah. So a great example of 5-year property that's considered tangible personal property would be like appliances, certain types of carpeting, laminate flooring, certain types of cabinetry, fixtures, things of that nature. Now, when you're looking at 7-year property, is usually undefined, so just random stuff you might find in there. I don't have any examples offhand. But
what about like landscaping? Where would that fall? Like plants and stuff like
that. That's the 15-year property. That's land improvements. So that would be like landscaping, pools, decks, outside plumbing systems, things of that nature.
Gotcha.
So basically what happens is that they kind of, I guess, take a step back here. You buy property, it's going to be depreciated over 27.5 for residential, 39 for commercial. Then you can have a cost segregation study performed. And when you have a cost segregation study performed, typically an engineer comes down to your property, like surveys the property, inspects it, comes back with a report and says that, okay, this is the amount of property you have, the amount of 7-year property, if any, amount of 15-year property you have, and then here's the amount of 27 or 39 years. So basically they're taking a portion of the property that would have been depreciated over that longer schedule at 27.5 or 39 years and saying, okay, it really falls under this 5, 7, or 15-year category.
Gotcha.
And that in and of itself can increase. Well, that in and of itself does increase your depreciation expense annually for at least 5 years, right? For 5 to 15 years. But basically what that Tax Cuts and Jobs Act said was that you could basically take that as an expense all in 1 year for that 5 15-year property. So rather than having to spread that out, you're just taking it all at once, which is substantial.
So back to our regularly scheduled program. So you were saying, so for a $500,000 property, you're giving us an example of what that might look like, right?
Right. So just for anybody who's listening, this is an example. You have to go and speak to a cost segregation provider or your CPA to get a more accurate read for your specific property. But let's just say it's a $500,000 property, about 25% uncommon is reallocated to that 5, 7, and 15-year life. That's about $125,000. And that would be a deduction in the first year using 100% bonus depreciation. So you can imagine how powerful that could be. Let's just say you're making $250,000 a year. You're able to get a deduction like that. You're not paying taxes on $125,000 of your income, and that could save you a substantial amount of money in taxes.
It's massive. So now a lot of investors that are listening are saying, yeah, Thomas, that's great, but that doesn't apply to me because, I've talked to my accountant and I make W-2 income. I got a job. So I have all this depreciation, but if you're making money off of your piece of real estate, that depreciation. So let's say I make $20,000 off of that $500,000 property. So I have a $20,000 gain that year. I have a $125,000 loss. What happens to the rest of that depreciation, that $105,000 in this example?
Right. That's a great question. It depends on your situation. So
great answer.
It's a good one because That's what happened. So,
Yeah.
right. So we have, so if you're a passive investor, meaning you're not actively involved
Yeah.
or you don't have an exception, this loss will, that basically say you have $20,000 of rental income. I believe you said, right? 20,000. Then
20,000. Yes, sir. Yeah.
you might have other expenses that come in there, but let's just assume depreciation was your only expense. You would have this 5K loss, and this loss would be carried forward in the future years. So it's going to offset your
Gotcha.
income. If you had other rental properties that had income or other passive activities that you may not be uh, uh, actively involved in, like a silent partner, for example, it would offset all that income, and then whatever is remaining would be carried forward to future years, where it could be used to offset your passive income in future years.
Yeah. I love that. It's one of these things where I like to say, if you're doing real estate right, you shouldn't be paying taxes.
Oh yeah.
If you're taking all these advantages. Now, obviously, there's that's a really broad statement. And it's interesting. You start off, real estate's a real long game. And you start off, you're like, okay, I'm making a little bit of money every month. Maybe I have a residential property or a syndication that I'm a part of. You see these big losses, and you're like, well, I'm not making a ton of money. I can't take advantage of these things. But over time, 5, 10, 20 years, in my understanding, and you can again, I'm definitely not a CPA. These start to layer on top of one another. So, for instance, and this is something that you and I have discussed at length and under, in kind of in different forum, but you may have that loss. So you might not be able to use it in one property, but you were saying is you may have another property with a substantial gain or substantial income, and you can layer the losses from those properties that fall in the same category. Is that right?
Right. So the passive
Yeah.
losses can offset passive income. So if you have
Yeah.
activities that are passive, for many real estate investors, it's just other rental properties they may have. Those losses can offset the rental income, for example, from your other rental properties.
Yeah.
Or if you sell a rental property, you can use those losses to offset the gain on the sale of that other rental property, or even the rental
Wow.
property that generated the loss in the first place. So that's
Can you say
specifically
that?
called
Can you
like.
say that one more time? Because this is something that I think is not well understood. And I actually took the article that you all published in the video and shared this with our community. So, what if you don't mind repeating what you just said? So, if you have a loss from one property and you have a gain on sale of another property, you were
Right. Yeah. So if you have a loss on, say, property A, and you
yeah.
sell property B, and you have a capital gain, that loss from property A will offset the gain from property B. And
Wow,
it's
that
kind of
could be
been coined
huge.
as like the late 1031 exchange.
Yeah.
And you'll see people, they know they're going to sell a property. They'll look at their form 85A, which is where they'll find their past losses, and they'll say, okay, great, I have enough passive losses, or I'm anticipating enough at the sale. I'm good to
Yeah.
go. Nothing I have to do. Other times they'll say I don't have enough passive losses.
Mm.
So what I'm going to have to do is I'm going to have to take those losses. I'm going to have to go invest in another property. So maybe they invest in another rental and they do a cost aggregate study, generate losses, and then those losses can offset the sale. Or they might invest in a syndicate as a limited partner, take the losses from that, and do the same thing.
Gotcha. Yeah, and this is where having a tax strategist really makes a big impact, because I think a lot of people that are used to investing in the stock market or kind of your traditional investments, there's not a lot of tax planning that goes along with that. But if you start to layer on these circumstances, and I talk about this in my book, you use 1031 exchanges, you start to layer different investments and losses and gains through proper tax strategy, you can really amplify your after tax returns.
Absolutely.
Yeah.
We see it all the time.
I know you guys do. So, all right. So kind of playing devil's advocate. So, we got a listener on and they're saying, that's all great, Thomas and Chris. You guys are, bragging about how you can save all these taxes, with your real estate, losses and gains and all that. But I'm a W-2 employee. Like what, that's well and good. What are some strategies that your typical W-2 employee can use, alongside with their investment strategy, Thomas, to help offset some of these gains that they have, or start to blend them in? Because I know you guys have some phenomenal resources on your website. And real quick, we'll say this again at the end of the show. What's the best place to check out some of these resources that we're talking about?
Yeah, so if you go to taxsmartinvestors.com, we have a bunch of courses. We have an insiders group. You could learn a lot of the stuff within that group, within the community. You get answers to your questions. We have live Q&As. So if people have questions, it's a great place to kind of get answers to.
Awesome. That's taxsmartinvestors.com. We'll have the link in the show notes. We'll also mention that again at the end here. Very good.
All right.
Yeah. So W-2 employee average, is there anything that your average W-2 employee can do that doesn't qualify as a real estate professional, or have a bunch of other, options when it comes to their losses for tax purposes?
Right. So I think everybody who, if you do have a W-2 job, you can absolutely use what we just discussed. That's like the pillar. But if you want to start using losses, if you don't want them to necessarily be carried forward in future years, and you actually want to start using those losses to offset the income you're earning from an active business or a W-2 job, what can you do? You can use the short-term rental loophole. So I'm going to try to give the Cliff Notes version of how this all works. So back in 1986, before 1986, you were able to just
1986. We got a lot of listeners that weren't even born then.
Yeah, I mean, it was way back. So like before then, you were able to just buy a rental property, a long-term rental property, whatever, and just use those losses that we just talked about to just offset your W-2 income. No problem. That became very controversial. People really didn't like that. So the Tax Reform Act of 1986 made all activities passive by default. And that's where that, passive losses can only offset passive income came about.
Gotcha.
Now, ultimately did a few years later, about 8 years later or so, they implemented the real estate professional status, which allowed people who work full-time in real estate to take the losses from their rental properties and use it to offset their active income. And there's a whole argument about why that is, but that's what happened. The problem is with the real estate professional status is that you have to work full-time in real estate. So to qualify, you spend more than 750 hours and more than half your total working time in a real property trader business. And if you have a W-2 job or you're running an active business, this is likely not going to be feasible. There's hundreds of tax court cases, and no one's really ever made it through having a full-time job. So what this introduces a great strategy called the short-term rental loophole, it's referred to. And the short-term rental loophole is an exception to the definition of rental activity. So all rental activities are passive by default. However, your traditional business, it could be passive if you don't materially participate. But if you do materially participate, and I'll get into what that means in just a second, then it becomes non-passive. You can use the losses. So if your property has an average customer use of 7 days or less, it is rental activity. If it has,
so this would be like an Airbnb, is that right? Like
exactly.
Okay.
Exactly. Now there's another exception that's somewhat into. It's if your property has an average stay of 30 days or less and you provide significant services. And that's things like daily cleaning, daily meals, maybe vouchers and tours and vehicles that they can use for free and things like that. So things you'd find in a hotel. So if you can meet one of those two exceptions, well, your property is now not a rental activity. And if you can materially participate, and to materially participate, you can meet, there's 7 tests, but let's go through the top 3 most people are going to qualify for. Is you spend more than 500 hours on your short-term rental property, you spend or do substantially everything yourself, which means you're pretty much a one-person show. And the third one is you spend more than 100 hours on the activity and no one else has more time than you. So if you can meet one of those 3 tests and your property has that average stay of 7 days or less, or that or less and significant services are provided, the losses are non-passive.
That's awesome. And I was going to ask you, you have 7 tests. You have to pass all 7. The answer is you just have to pass one of the tests to qualify, right? And so I think this is, if you're listening and you're a professional, I have friends that are doctors, that are surgeons, that are professionals. I won't name any names, but I know we know some in common here whose spouses have gone and taken advantage of this because they have intentionally gone and structured this where they have a short-term rental business and they were making, money working, part-time or doing another job. And now they manage this portfolio. And what that means is that the couple now is able to take losses from their real estate portfolio and offset their W-2 income.
Yeah. So there's kind of two
Wild.
things going on.
Yeah.
Oh, there's kind of two things going on there. So the
Yeah.
real estate professional status, like what we've seen a lot of people who have the long-term rentals, they'll have if one spouse qualifies, meets that 750 and more than half their total working time test.
Yeah.
If one spouse qualifies, then they're both real estate professionals. And now that is for a long-term rental property.
That's
so
different.
Words, yeah. So
gotcha.
That's a
Gotcha.
little box.
Okay. Thank you for clarifying that.
No problem. Just because I know people out there, they when they hear this stuff, they running with it, and I just got to make sure that
yeah. Stop. Call Thomas. Reach out. Yeah. Don't try this at home. We should have a warning.
Right. Proceed at your own risk, and then you have the short-term rental side, and that you don't need to work full-time in real estate, which is why a lot of people.
Gotcha. Okay. Yeah.
Because in the real estate professional side, say I'm working full-time, right? If I would have my wife, say, for example, she qualifies as a real estate professional, then we would both be real estate professionals. But I would have to, in my scenario, I'd have to be married and she would do it. But let's say that I can't do that, right? Well, I can still use the short-term rental loophole because all I need to do is materially participate. I don't need to spend half of my total working time in real estate. And that's what makes the short-term rental loophole so lucrative, is because it allows you to buy properties, operate these properties in substantial losses, and offset your income without having to be full-time in real estate.
That's wild. And you have a book or a resource on this, don't you, on your website?
So we have a guide, the ultimate guide to the real estate professional status, and within that guide we do discuss the short-term rental aspect of it as well. So that's a 1,200-word comprehensive guide. If you're going to go and use one of these strategies or you just want to learn more about it, definitely worth checking out.
Yeah, what I'll do is I'm going to go ahead and pull that link up right now and make sure we have that in the show notes as well for everybody if you're listening along, because it's really interesting. I think you made an interesting point, Thomas. You said in 1986, so this goes back to when they formed the tax law around hospitality, right? And that's where short-term rentals now kind of fall into place. So, it is, you called it a loophole because it's the space that is applying to, the hospitality industry, which has transformed massively over the last 10 years.
Right. What ended up happening is I imagine the lawmakers who wrote this foresee Airbnb becoming a thing. And, back then,
there was no internet back then.
Yeah, I mean, how are you? They probably didn't. Back then, it was going to take significant effort to run a property at 7 days or less, and usually only motels, hotels, or true Airbnb business, not Airbnb, excuse me, true B&B businesses. We're going to be able to do it. Your average person wouldn't be able to go buy the property down the block, for example, and put it on Airbnb and rent it out for 7 days or less. So,
yeah. No, it is wild. I remember when you first told me that, I was like, oh, okay, this kind of makes sense now. Now, all right. Now I'm going to play devil's advocate a little bit. So we've talked about some of these tax strategies that people can use when it comes to real estate. But last year, we found out we're going to have how many new IRS agents run around out there?
I think it was 87,000.
87,000. That's to me, that sounds like a lot of IRS agents. I don't know what the percentage is. I remember reading stuff online. They're going to be armed and all this stuff. So it's you have these images of, the IRS popping up, out of your bushes with guns and saying hey, give us your receipts. Should people be worried about that? And why, this is kind of a leading question, but why, or how can people be a little bit more confident about, applying some of these strategies that you're using?
Yeah. So the big thing there is you want to document everything very thoroughly. You want to have an airtight case.
Yeah.
So like say, for example, if you're using the short-term rental loophole or the exception, as some people call it, you would want to make sure that you have documents showing that your property had an average stay of 7 days or less, for example. You want to have that clearly and readily available. And I know with like Airbnb and VRBO, it's relatively easy to get that information. So you want to go ahead and download that, put it in a file somewhere safe. So you have that for your records, because audits don't always take place right away. It could take place a few years down the road, and you might not remember everything by then. So you just want to have that ready to go. And
How
secondly,
long? How long should we keep receipts on that note?
so 3 years is the typical recommendation.
3 years.
That's like the audit window.
Yeah.
So yeah, within usually for 3 years you want to keep.
Okay.
You want to keep.
Terrific. All right. So okay. So keep good receipts, and then you're about to say something else there as well.
Yeah. So you want to have that. And then you also want to have your time log. So if you're using the short-term rental strategy or using the real estate professional status, you want to make sure you have time log. One of the biggest reasons why people lose cases is because their time log is either non-existent or not credible. It's usually not credible because they don't have one. And then when they get audited, a year or two down the line, they have to go make it up. And I don't know about people listening, but I don't remember always exactly what I did 3 or 4 days ago, let alone years later. So you want to make sure you're keeping a active time log of your hours so that you could prove you met one of those material participation tests, and that if you do get audited, you could fully generate that, hand that over to the IRS, and or work with your tax professional before you do that. But you want to just have that ready available. That's the biggest thing you at the end of the day, you shouldn't necessarily shy away from more advanced strategies or more complex strategies. But when you do use those types of strategies, you just want to make sure you have everything, all your T's crossed and your I's dotted, so that if an audit ever does come, you're ready to go.
Yeah. And I took some people have heard this story. I took a course from a former IRS agent when I was, I think I was in grad school at the time. So I was in my early 20s. And the saying that he had, his name was Sandy Botkin. I'll never forget that. And he said, be aggressive and keep detailed records. He said, keep detailed records. So I want to be clear that what Thomas and I are talking about, we're not saying, hey, cheat the system, do this. What we are saying is learn the code. And I often say, if I was playing Monopoly and you had never played before, it probably would seem like I was cheating because I'm so much better. Learn the tax code, keep detailed notes, set up your systems. I have, like you were just saying, I have time logs that I use. I was actually just making myself a quick note here to update mine. I have a mileage tracker on my phone. So when I go visit a property, it goes right in there and I can print that out for my CPA, which is you guys, to use. I keep all my receipts, and I have a bookkeeper that follows all this. I take pictures of receipts with notes about what those were for. The tax law, it can be complex, but it can be simple to follow the rules as long as you learn things and you set it up, right?
Yes, absolutely. Absolutely. No, sorry. It's absolutely powerful. And if you know the code, the rules, and what to document, and you know how to put a bow on everything and keep your situation nice and tight, then you're going to be in good shape. You shouldn't shy away from strategies just because the fear of the IRS. Otherwise, you're just going to end up paying more taxes than possible. More taxes than you need to. Yeah, that's just, you don't want to do that.
Yeah, and this is a terrific segue here to kind of put a little positive spin on all of this. In my opinion, now I see the IRS as a partner. They tell me the rules that I need to follow and how I'm going to benefit if I follow their rules. And then I follow their rules, and I pay taxes, and I also get some tax benefits if I do what they want me to do. And then I call you guys and I say, hey, this is what I'm looking to do. And you say, yeah, that's reasonable. This is reasonable. These are the rules you need to follow. And I certainly don't want to get audited. If any IRS agents are listening, but I'm confident that if that does happen at some point in the future, then I'm following the law appropriately and doing all those things. Now, Thomas, I'm excited. As we were talking here a little while back, you guys are launching a new platform, and I wanted you to share that with the audience before we say goodbye today.
Oh, absolutely. Thank you. So yeah, so we launched Tax Smart Insiders. It's our like our private group. Kind of what we realized is that we couldn't help anybody with one-on-one tax planning. So we said, how can we help more people use strategies like what we discussed today and make sure they're doing everything the right way so they can minimize their taxes? And we said, hey, great, let's create a community. We have information there, live Q&As, a private forum with our accountants who answer questions. So you can learn more about that at smartinvestors.com/free gift. And you can actually get like a really cool welcome box. It's going to have a baseball cap, a few free books, a print version of our newsletter. So that's exciting. And taxsmartinvestors.com/free gift to check that out.
Awesome. Yeah, we got that in the show notes here. And look, I can tell you that, I've been fortunate to work with you guys here for a couple of years. The resources you guys have on your website's phenomenal. The information you shared with our coaching group is phenomenal. You've certainly saved me, hundreds of thousands of dollars in taxes by learning the proper tax code and following that. It certainly took me several years to kind of get everything set up. But I love what you guys are doing. I don't know of any other group out there that specializes like the real estate CPA does, Thomas. So I really appreciate what you guys are doing. Thank you so much for joining us again and sharing all your knowledge with our audience.
Likewise, Chris. Thanks for having me on.
Always. We'll be back soon. Hey, Chris here again. I hope you found this episode valuable. Now, I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.